in Asia today. Very little change, barely a heartbeat at $93.26. The price has been pretty stable in recent days, sort of hugging into that low 90s. The floor seems clearly bedded in at $90 on Brent ever since the OPEC Plus move to cut quotas starting next month. Of course, oil prices have stayed firmly, at least on Brent, below $90 a barrel. Let's kick off this morning with Robin Mills, the CEO of Kamar Energy. Robin, we had a fairly dramatic statement this morning out of Singapore by the head of the IEA, describing that the world is in its first truly global energy crisis. You wouldn't notice that by the oil price looking fairly boring and stable in the low 90s. Your thoughts on Fatih Birol's dramatic statement?
I think this is pretty consistent with what Fatih's been saying, since earlier this year, really. And I think, look, what he's pointing to is that this is a crisis of all energy forms and indeed commodities beyond that, right? So it's been a crisis of gas, particularly of gas, of electricity, of to some extent food, of to some extent different kind of metals. But weighing on all of this has been the recession concerns and the Chinese concerns about the Chinese economy and its short-term and its longer-term direction. And you're absolutely right, Sean. We haven't seen that crisis, oddly enough, in oil so much, or not in oil prices. We've seen a lot of chaos in the oil market because of sanctions and the oil price cap and more measures coming in shortly. But the price itself is not particularly high by historic standards.
Let's go to Asia, to China. Victor Yang, senior editor at the JLC Network Technology. Victor, good morning or good afternoon, I suppose, for you.
Yes.
Good afternoon. Obviously, the big news in China, the end of the party congress. What does that look like, feel like from your perspective? What are the big takeaways you think that the world should pay attention to?
Well, my biggest takeaway is the direction for China in the future. And Xi pointed out, the Chinese style modernization and what it means, including common prosperity, the modernization of all the people, and the development of not just material, but also culture. So it's kind of guidance for the country in the coming years. And the policy to stick to greater opening and will not change. And this is very important too. And as we said earlier this year, some countries try to decoupling from China, but it's quite unlikely, it's very difficult. So say like Germany is now going to visit China, and it's quite different to its previous remark. And we can see that we expect this opening will deepen in the future. And meanwhile, the economic growth will be more focused on high quality. Say not like before, but a lot of attention and emphasis on technological innovation. And a focus on talents, education, and innovation. This is, it becoming more important in the future development. Yes.
Let's go to Jose Chalhu, political risk and oil analyst in Venezuela, in Caracas, Venezuela. Jose, the big news story this week, I would think, in Latin America is the runoff election in Brazil between the two top candidates there. Of course, the current president and the former president. We have Bolsonaro, Jair Bolsonaro, running, who was second in the first round to Lula da Silva. Your thoughts on the outlook for that runoff election and what it means for Latin America?
Yeah, thank you, Sean. Thank you very much. Well, yeah, I mean, first of all, for that election, there were, the different polls, all of them failed to get the scope of how President Bolsonaro got his second place, got to reach that level of, of percentage of votes. No one, I mean, no polls expected that. No, I mean, it was very surprising, but it's still comprehensible for the level of popularity that Bolsonaro still enjoys in the country. It'll be a very contested runoff election in the coming days. I mean, and we're talking about two extreme poles of ideologies, the far left and the far right. But in this case, former President Lula da Silva had to make some choices to get to a little bit more into the center, to moderate his economic policies, because to attract the different candidates that got into the third and fourth place, in terms of attract the votes needed to get the victory in the coming elections, with Petrobras, with the future Petrobras at the center of all of most of both of the candidates' agenda. Petrobras is the Brazilian company, the Brazilian oil company, which is has been at the center of Brazilian politics for the last years, considering the importance for the country. And yeah, for me, it'll be a very contested election.
When you say contested, you mean close?
Close, and considering the level of political violence as well in the country.
Although Lula was like 4 percentage points higher in the first round, does that not indicate that he's more likely to win, or with the other candidates dropping out, are they more likely to go to Bolsonaro?
It'll depend. Yeah, it'll depend on how the two other candidates will. I mean, on who will they choose to lean on. But yeah, I mean, the polarization is still running high in the country, according to different sources, according to different friends still living in Brazil, and it's understandable because of all the confrontation between the two candidates. But it'll be a very tough race.
Robin, your thoughts on the equity markets and what they're telling us at the moment? We saw yesterday just two extreme opposite experiences. The Chinese Hong Kong markets sold off quite significantly, 6-7% drop on the Hong Kong index. Meanwhile, the US markets rose dramatically on some expectation that the Fed are already signaling a plateau on rates. Let's address that one first. Your thoughts on what that means if the Fed indeed are going to pause?
Well, that's important if they do. But look, and I think a major driver of this is the pullback in gasoline prices, right, which has been a driver of inflation, and particularly of headline inflation, and also an important political driver, right? And if we see that pullback in gasoline prices continuing, then that suddenly eases the Fed's task, it eases Joe Biden's task as well. I have concerns over that, though, particularly over the diesel side. Diesel is an important structural driver of inflation. It goes through transporting commodities and goods around the economy and so on. And the diesel market is very, very tight. Stocks are to record lows for the time of year. They're like at the record low since the presidency of Truman, which is kind of 70 odd years ago. And they could get a lot tighter because we also have the ban on Russian oil coming up in at the start of November, and then we have a ban on December, and then we have the start of the ban on Russian oil products in February. And Russia is a very important exporter of diesel to Europe. If that ban is effective and is taking Russian diesel off the market, it's very hard to see what replaces that. So that could be a driver of renewed inflation. So this kind of, I guess, optimism that inflation, at least in the US for now, is contained might be a bit premature.
Yeah, the equity markets maybe getting ahead of themselves. On the Chinese side, clearly the equity markets in Hong Kong didn't like what they heard over the weekend with the Communist Party Congress in Beijing. A little concerns about the outlook there for further growth.
Yeah, and I'll defer to Victor on this, but at least my impression is a couple of important signals. No let up on the COVID zero policy, and that'll mean further lockdowns as necessary, and therefore slow economic growth and slow oil demand growth in China. And then just a longer term picture that there will be a switch towards structurally slower growth, a lack of real reform, and an acceptance that the long-term Chinese growth rate has dropped significantly. And that, of course, is important across oil and across all commodities, and important on the gas side as well. Chinese gas imports are down this year for the first time in many years. That's a function of high prices, but again, also of a rather slow Chinese economy.
Victor, just picking up on that, we did have the China Q3 GDP growth numbers yesterday.
Yes.
They were better than expected, quote unquote. Obviously, they showed a rebound from the Q2 numbers, which were essentially no growth with the COVID lockdowns. But Q3 did show above 3% growth. Your thoughts on that trend line and where it goes? And again, coming out of the Congress party would indicate COVID zero is still baked into the 2023 economic outlook.
Yes, well, and a large part of the contribution was made by consumption. Say consumption did grow faster than in the second quarter. And a lot of consumption is now online, different than before. Say, take me, for example, I didn't do online shopping that much, but now I prefer online shopping more than other shopping. And there are some other drivers too, including innovation and exports, mostly and exports too. And there are still a lot of challenges, not just some, a lot of challenges for the last quarter of the year. And we do not expect it to grow much faster than in the third quarter. The zero COVID policy will not change, at least in the near term. This will remain something to restrict the growth too. And as for oil demand, well, from 2019 to August 2022, China put away slightly over 1 billion barrels of crude into its tanks. Say about 1.2 million barrels per day in 2020. And in 2029, close to 880,000 barrels per day. And this stop building continue until the middle of 2022. So you can see it has put away quite a lot of tanks, barrels before this year or before the middle of this year. So this will also slow down its demand growth in the future too. And as we can see from yesterday's data, imports in September was about 9.8 million barrels per day. And this is quite steady on months. And it didn't drop that much on year as in August. And so we do not expect it to grow very significantly yet in the last quarter. The one difference is oil exports, oil product exports, say gasoline, diesel, and jet fuel. Actually, diesel exports surged in September, surged to 1.3 million barrels in September. That's quite different to the past few months. And we expect these exports and gasoline and jet fuel to surge further in November because of the extra quota released in late September. And in September and October last year, the severe diesel shortage has served as a lesson. So state-owned refiners have been building up stockpiles, diesel stockpiles. They slashed diesel exports by about 83% in the first 7 months, and then to about 70% in the first 8 months. So it's quite a dramatic plunge, different to say compare with about a 30% in gasoline and a slight increase in jet fuel exports. So they now, as we mentioned once, September is the strongest season for diesel demand in China. And now this season has arrived, and refiners can find out whether they can release more stocks because it's already the strongest season. So that's the difference now.
Jose, I wanted to get your views on the release earlier this month of the 7 Americans, including 5 oil executives that were released from 5 years of prison in Venezuela. I'm wondering, how important is that? Will it help to heal relations with the US, Caracas and Washington? What's the impact so far a few weeks later, and what's your outlook for that?
Yeah, well, it's a policy that Caracas has been adopting in terms of having these prisoners. I think that there's more US citizens jailed in Caracas and Venezuela. And the government is using clearly them as bargaining chips with the Biden administration in terms of getting some concessions or potential lifting of sanctions. But as I always say, this will much depend on the midterm elections in the US, the results that the Democrats will get, because I mean, it's unpredictable because coincidentally, Venezuela and the US will have presidential elections in the same year. So, in the 2024. So I see this as clear a strategy adopted by the Maduro government now that it's been speculated that Washington is going to strip off his recognizing of Juan Guaido as interim president, and that's the speculation. So that gives Maduro a little bit more of oxygen, a little bit of more leverages, but I don't think that this will lead to any lifting of sanctions in the
so there's no breakthrough in sight, despite the global tightness. Washington, desperate for more oil supply in the world, still not willing to do a deal with Venezuela or Iran. That's dead now, it would seem, the JCPOA deal. But in Venezuela, these prison releases hasn't signaled any thawing in the outlook.
Yeah, but I mean, you can't. I mean, as I say, you can't just fight geology. I mean, here our production has been stuck. I mean, according to the recent OPEC monthly report, our production plunged again below the 700,000 barrels per day. So I mean, you have two different things. You have the political and geopolitical strategic calculus, but I mean, we have years of depletion, years of mismanagement of our oil industry. So you just can't, I mean, how many more barrels you can recover from our current levels of low production? I mean, in the short term, I mean, the calculus is up to 1 million barrels per day. That's it. I mean, you need lots of investments. I mean, according to different reports here, Venezuela needs at least over $50 billion to start recovering our oil production and our oil refining sector. So, wow. I mean, you're talking about two different things here.
Yeah. Let's get the survey question in, looking at these comments that we started our conversation with. The head of IEA said today in Singapore that the world is in its first truly global energy crisis. Some would say that given the previous sort of energy crisis of the 1970s, which is what this period has been compared to, that was very much a European Western experience. But this is, because that's where the embargo was, but now this is global. Getting an LNG tanker in Asia is as difficult as it is elsewhere. So your thoughts in agreeing with the sort of sort of dramatic statement, I suppose, by Fatih Birol. I mean, as Robin was saying, he's kind of been giving us this language for some time now. Robin, I wanted to get your thoughts. I haven't heard yet, at least not on our podcast, your reaction to the OPEC Plus decision, which of course kicks in early next week, in terms of November 1st being the action of the quota cut, the 2 million barrel a day quota cut by OPEC Plus. Your thoughts on it from the point of view of a market managing exercise, and what do you expect it tangibly to deliver? You're on mute. Sorry, Robin.
So there's been a lot of speculation, about the politics of this. I'll leave that aside for now. On a market point of view, I think the timing is a bit odd. Okay, we've seen a slowdown in demand, possibly. No, actually not too many tangible signs of that. We've certainly seen a significant fall in price, right? And that price has been falling ever since June until the OPEC action. In terms of what it actually means for the market, 2 million barrel a day cut, that's going to be 900,000, a million, practically of real cuts, and perhaps less, depending how much compliance there is. Iraq may under comply. Kazakhstan is coming back from some maintenance. So, the actual cuts will be 900 or a million at best, perhaps even less than that. So, and OPEC no doubt had that in mind when they announced it, knowing the real effect would be less. But as I say, I do find the timing a bit odd. The previous months, if you recall, you had an increase of 100,000 barrels per day, and then you had a decrease of 100,000. Then to suddenly go to a decrease of 2 million, when there's really been no dramatic economic news since, kind of a moderate deterioration, but nothing dramatically different. That's really a big shift in policy, and that I find a bit surprising ahead of the sanctions on Russia coming into effect, of course, in December, and of course those sanctions will start having an impact ahead of December as loading schedules are finalized. You would have thought it would have been more natural, say maybe a smaller cut, maybe 500,000, and then see how December looks, and then you've still got the option for further cuts. So this is really quite a dramatic thing.
Well, when you see it at that size, 2 million from a quota point of view, of course, every country has their percentage of that. But for the Gulf states, their percentage would be quite large, and no one else will be cutting except them. Do you think that appetite is there in the region to do that?
Well, absolutely. I think that's a critical point, isn't it? The two who are going to cut more than anybody will be Saudi and the UAE, perhaps a bit of Kuwait, and then Iraq if it decides to follow. And I think historical practice would show it probably won't. So really, the decision was driven by Saudi Arabia. Clearly, Saudi policy and Saudi market opinions are behind this. So I guess it's up to them how much of that burden they felt comfortable taking. The UAE is an interesting one because the UAE had been pushing for its quota to be increased, of course, over time, and it was increased last year, and increasingly has more and more spare capacity, and had been gradually using that up as production increased, but now it's got to its spare capacity will go up again, and the UAE, of course, does not just have very aggressive growth targets. I mean, the most aggressive growth targets within OPEC. But it actually made those even more aggressive, privately over the past couple of months, trying to accelerate its production targets to 2025 and even set an even higher target for 2030. Now you'd have to wonder, well, if that higher target by 2025 is achieved, will it even be able to use it?
Yeah, they seem to be very determined to increase their capacity for the purpose of using it. They will have to sort of see where the markets are at that time. But Victor, I wanted to get your thoughts on the VLCC day rates that are now up about $100,000, supposedly on reports that Chinese refineries are buying more crude oil, pulling big VLCC tankers all the way to China, and the rates are 100,000 a day. Does that seem to make sense to you?
Well, not that much yet, from the information I get. And we expect October imports to grow modestly because of two new refineries. One is expected to start commercial production in early November, And the other one is PetroChina's refinery, which was actually previously intended to be built together with Venezuela in Guangdong, but Venezuela pulled out, and it's 400,000 barrel per day refinery is starting this month, late this month. So we expect this to contribute to some growth, but will not be very sharp. No.
The outlook, as you said earlier, for the 2023, and given the somewhat diesel product shortage in the world, what is your expectation for quotas in the first quarter? Will we see another surge in product quotas, product exports for Chinese refiners to export in the first quarter of 23?
Yes, we can still see some, well, to see the export stay elevated, not surging from the current level, because it will be already quite high in November. According to our data, our data shows that November exports will hit 6 million metric tons. That's about 2 million metric tons for diesel. And if we cut into barrels, that would be quite high too. And for the last batch of quota that the government released in late September, it will stay valid until early next year. So refiners can choose to use some of the quota in the first months of next year. So this will help to bolster the exports too, and particularly when domestic diesel demand is seasonally weak in early in the year. And so we can see China's quota and exports to rebound modestly from this year, but not dramatically. This doesn't mean a change to the policy. It's just, well, expedient because of weak domestic demand and the need to give a boost to its economy. Yes.
By exporting more products.
Yeah. Yes.
That certainly will be helpful, one would think, as to the European winter, to see more products on the international market, particularly diesel. Let's give the last word to Jose in Caracas with the survey result. Jose, I wanted to get your thoughts again just on the geopolitics of the election in Brazil, a very serious election, given, as you say, the extreme difference between these two men and the policies that they would bring into the presidency. Where do you think the rest of South America is in who they would wish for to win? And particularly from the Washington's point of view, who do you think Washington would like to see as president in Brazil?
Well, when Lula da Silva was ruling, Brazil didn't do bad, at all. Actually, it did good during his 2 terms as president. His economic policies in general were positive, not as much as with his successor, Dilma Rousseff. His policies regarding Petrobras and other strategic companies were positive. Brazil is a strong economy. It's the strongest economy in South America. So, despite who wins, I think Brazil will do well. Petrobras has been doing and performing really positively. It's producing over 2 million barrels per day. It has tremendous outlook. It's one of the top performers and with positive outlooks of production for OPEC, along with Guyana and South America. So despite who wins, I think for Washington, it's my view, it won't matter. And considering the experience that Lula has or had in the past, and also I say that first, for the left that's now ruling, or in South America and most of the countries, the economic landscape, macroeconomic landscape, it's not that positive as it was in the past when we had the Hugo Chavez, the Kirchner in Argentina, the Evo Morales. So, I mean, we're seeing a moderation of the leftist policies as we saw them in the past, at least for the coming 2 years, I see, considering the whole problems that the region is experiencing as well as other
So
regions.
you're really talking about sort of center left rather than the far left of Chavez and others in the past. Lula has moderated and could be, from a U.S. perspective, more of a Democrat than a Republican, and given that Bolsonaro was like Trump's best friend. We'll have to leave it there and keep an eye out on that election result at the end of this week in Brazil. Very, very important for the direction of South America. In the meanwhile, we'll have to wrap it up. Brent crude oil, little change this morning in Asian trade. It is worth noting that the spread between Brent and WTI has grown quite significantly at $10 now, with WTI trading at 84.82 and Brent some $10 higher. That spread had narrowed a lot more in recent times, and now it's blown out again. I have to look into what that tells us. But thank you, Robin Mills. As always, great to have you back at the table with your insights from the Middle East. Victor Yang from China, Jose Shalhoub from South America. Nice to have the whole world in half an hour. Thank you very much. Have a great day.
You too.